the one thing I look at every month, the monthly job report. Once a month it comes out. Real estate's just a box where the economy lives. And so we need to know just how many jobs are being created. So how many people are going into a job every day. They fill the space. They form the economy. And that's going to be the broadest leading indicator of where the market is.
Welcome to Boots on the Ground, the #1 real estate private credit podcast, mostly because there can't be that many. My name's Boots Dunlap, and I'm the CEO of RRA Capital. Most episodes will dig into commercial real estate, finance, and the market, plus whatever else I find interesting. The standard here is simple: honest, transparent conversations. This isn't a place to talk your book. We'll challenge assumptions, follow incentives, and get specific. All right, let's get into it. Today's guest is Jim Costello from MSCI Real Assets. Jim co-leads global research for real assets and is based here in New York City. Prior to being at MSCI, he was the economist at Real Capital Analytics. And prior to that, he spent 20 years at CBRE Turer Wheaton, where he conducted investment research and market research, and ended up becoming the co-leader of the group there. So thanks for being with us.
I am so happy to be here today.
Out of the gate, I've got a question for you.
Okay.
What is the one signal that you find most important to be watching in 2026 that will have the biggest impact on commercial real estate values?
It's still the same thing I was looking at last year. My #1 chart last year in all my presentations was a chart of uncertainty. You can go to the website, policyuncertainty.com. They produce a daily index of uncertainty from reading all the business publications in the world. They don't physically read them. They have a large language model going through it. But it rates the degree of economic uncertainty on the part of the authors of these business articles. And it surged last year. There are major changes coming from DC that impact all the institutions that underlie the performance of the economy. And uncertainty is so critical because every investment that's made is done on a forward-looking basis. And when you're doing that, you have to make some assumptions about what the future looks like. If I'm making a loan, what's the probability of getting paid back on that loan in 5 years? Well, what's the underlying environment that that loan will be paid back within? And as you change all those institutions, it makes people step back for a second and think about repricing what they're doing. But the uncertainty last year didn't kill deal volume. We still had growth in deal volume, but it was certainly something that was dragging down everybody's thinking.
So I'm going to push back on that because I feel like, if anything, American investors and the U.S. population has become extraordinarily comfortable with a lot of uncertainty from day to day. And you see the headlines, and it doesn't seem to be having much impact that I see in the general economy. And see, these are some of the, in terms of headlines, from day to day, some of the biggest news headlines that I've seen over my life are happening, month to month. So it feels like that the population is somewhat kind of not listening to all the headlines and news. And so I challenge that uncertainty really is having an effect.
There's some debate on this issue. Mark Zandi wrote an interesting piece the other week highlighting how job growth has really petered out. It's not growing at the pace it was in the previous 2 years, and he had attributed it directly to the impact of tariffs. You have to think about what tariffs are. Tariffs are a tax on consumption activity. You increase the cost for individuals, suddenly they don't have as much free money to be spending on other items, less disposable personal income. And in that kind of situation, a little bit of pullback, a little bit less manufacturing, you can have less job growth. Now, it didn't happen like that in 2018. In 2018, when tariffs were introduced, the firms absorbed those costs instead. And there was a period then when share prices from many firms that used imported goods fell because there was too much competition in the economy. They couldn't push those costs onto consumers. This time, there's evidence it's being pushed onto consumers, and it is dragging on job growth, according to Zandi. Some people may ascribe other issues to why job growth has slowed, but it's not growing like it was the other year. We're certainly seeing some pullback in construction activity. Those are good blue-collar jobs. And that is also a function of just the higher cost of capital. So there are some uncertainties out there, that are limiting the potential for the economy.
So I fundamentally agree with the idea that a tariff is a tax on the people. However, there was a lot of concern about where inflation would be, and we're still sub 3 in terms of PCE or regular inflation. And so as you look at the tax and really things getting that much more expensive, we've been somewhat conditioned over the past since 2020 seeing things become more expensive. But I think the U.S. average for PCE is around 3.3%. So as far as like a slowdown in the economy, it seems as though inflation isn't too out of control, and that's where you'd see the tariffs, right?
Well, it's a tricky thing measuring inflation. It's a basket of goods.
Yeah.
The BLS goes out and looks at a whole group of items and measures the price and thinks about what does the average household spend on. 1/3 of that index is shelter costs. And that shelter cost component has been the primary driver of a lot of increase in inflation in recent years. Now, we're coming on the downside of that now. We see it in the apartment market as investors underwrite new acquisitions. There's a little less income growth that they can put in there right now because we're coming off of a period of excess construction of apartments in many markets. So there's a bit of a cool down in the biggest component of the index, but that's non-tradable. And in fact, it might face pressure in the future from the slowdown in construction today. That's what a lot of investors who are still active in the sector are kind of hoping for, that the slowdown in construction we're seeing leads to stronger rent growth 3-5 years down the line. So it's a complicated web. It's not as if there's an announcement and then prices go up tomorrow. In fact, we've seen the industrial market weirdly do well for part of the year because of tariffs. At first, firms were trying to front-run tariffs and bring goods in before prices went up. And so you saw just a mass increase for a while of industrial leasing as they're trying to backfill stuff. So it doesn't all happen all at once and all at the same time. But the housing issue, we do have a period of some slowing rent growth that's impacting the inflation index. There's a little bit less growth there at the moment, but the pressure is still on. And individual firms are facing challenges now that some of the inputs to their process are more expensive and they can't hire as many people. And there is an argument around that we're seeing slower job growth than we could as the economy absorbs these new costs. I'm not saying it's right or wrong, but a new cost comes in, it has to be reflected somewhere in the economy, and a little less job growth, a little less growth in spending kind of fits.
So looking at 2026, how do you feel? What is your projections for U.S. GDP, and is this going to be sort of continued growth from where we were in 2025?
Forecasting in this kind of environment, I don't do formal forecasting so much anymore, but even if I did, I'd have a hard time answering that question because, again, institutions matter. The structures that people have around whether you can go to the bank and get a loan, whether you can use a credit card, all of these things are being thrown into play. And so in that kind of environment, if you take away, say, Fed independence, what happens next to interest rates? What happens to inflation? There's some evidence globally that it doesn't end well, but is that same thing going to happen here? It's a harder thing to take a look at. And so forecasting in this kind of environment is difficult because typically when you're forecasting, you're making assumptions that you have a relationship between certain variables historically, and all those relationships hold more or less together. So what I mean by that is if productivity increases, for example, suddenly you get growth without inflation and everything is better. But if the productivity comes about for new reasons, maybe there's some brand new AI instrument where suddenly no more office workers are ever needed. And that's just, I don't think it's likely, but it's just an extreme case. And suddenly you don't need any more office workers. And so, you get some more productivity, but it doesn't make the economy better because you lose all the consumption activity. So you need these kind of structural relationships in there. But as those structural relationships around institutions change, things can happen that are unpredictable. And that unpredictability introduces a sense of caution on the part of a lot of investors.
Yeah, it used to be you could just kind of look at supply and demand, but it does seem like there's a lot more external factors playing into commercial real estate, particularly capital flows. And I'm curious, now that you've been studying the market for as long as you have, I find that sometimes commercial real estate research and studying as an economist can be somewhat challenging because the market doesn't move that quickly, and it's not like, I've said this before, there's a reason why the real estate section or the commercial real estate section of the Wall Street Journal is just listings of celebrity homes, just because it doesn't change that much that quickly. So I'm curious, as you're doing your job, in the past 90 days, what has changed that you think is very quick and very interesting and will have downstream effects?
It's a great time to be asking that question because we did just publish our year-end analysis today. And the one thing that was kind of interesting to me about the fourth quarter, I'll take your 90 days and just talk about the fourth quarter.
Mm-hmm.
Fourth quarter, we had deal volume growth for every major property type. But we've seen a reversal of investor interest and the growth in deal activity. For a good long while after the interest rate spike that we went through in 2022, the leading investment sectors for growth were the apartment sector and the industrial sector. There were a lot of reasons that investors wanted to get exposure to those sectors. The institutional folks especially wanted industrial exposure because it was the one sector that was outperforming in terms of price growth and on a return basis. But those two sectors had only single-digit growth in sales activity for fourth quarter. The leaders were the office sector and the retail sector. And those were the two redheaded stepchilds of commercial real estate investment in recent years because everybody saw that, nobody's going to the office anymore, so who needs offices? And retail has been the whipping boy for the commercial real estate world since around 2000 when everybody saw that Amazon was the thing and that, people are going to be shopping online. But what they both have that is changing, there is some income growth for each. In the retail sector.
And is it because they're just bouncing off the bottom?
A little bit of that, but there's other issues as well. In retail, for instance, let me talk about retail first.
Yeah.
Office is probably a little bit more bouncing off bottom.
Sure.
But retail, we've been demolishing old, unneeded retail properties.
Yeah.
That we were over-retailed in the U.S.
Yep.
A lack of zoning controls and cheap capital and an incentive to build. There was a lot of construction in the 70s and 80s that just didn't make a lot of long-term sense. And those assets are slowly trading out of the bottom. Think back to 2007 and the boom we had then. Centro bought a whole bunch of regional malls for something like $200 a square foot on average. Some of those malls now are trading out at $7 or $8 a square foot price. And when you're buying it at that price, you're really just buying the land costs for the most part. There's a few investors that bought some of them and just thinking, I can run this scabby little mall. It doesn't matter what tenant I get in there. I get a little bit of income, and at that basis, it's fine. But for the most part, it's just trying to get to the land. But as you get that land and scrape away what was there for some of the older dead malls, the survivors suddenly have less competition. So the spending increases that happen, they flow to those existing malls. And what's been happening is that NOI per square foot for the institutional quality properties, it's now higher today than where it was in 2019. Combine that with consumers that had still been spending and also spending a little bit more on experiences as opposed to goods. I mean, this is especially a story in 21 and 22. Remember the term revenge spending? When everybody was like, I can...
Well, I remember revenge travel, for sure.
That too.
That was
But that was fueling things for a bit. But you're doing that not online. You're going to malls. You're going to places. You're going to a nice dinner. You're going to the experiential aspects of some of that.
Well, from your research, sorry to cut you off.
Yeah.
I know that I was kind of surprised as we were talking. I didn't realize that U.S. vacancy rates in retail were lower than they were in industrial. And for the past 15 years, they've obviously been significantly higher, which is a pretty phenomenal signal. And then on just your comment regarding malls, one thing that was thought was interesting is I have kids that are, they're Gen Zers, and they are definitely far more interested in going back to brick and mortar, which shocked me because they are always on their devices. But one thing that I thought was interesting was if you look at some of the original retailers that were very big, such as Sears, Montgomery Ward, Bass Pro Shops, Cabela's, Restoration Hardware, Williams-Sonoma, even J. Crew, they all started off as catalog companies that went to brick and mortar. And I feel like catalog might have been the e-commerce before the internet, where you do, there's probably plenty of local stores that got killed by catalogs. And I saw on CoStar just the other day, I don't know if you saw, but Amazon is now getting into mega boxes where they're trying to compete with Walmart and Target. And in Chicago, they're building a giant one to build a mega brick and mortar store, which is just blows my mind in terms of, cyclicality, which we thought for sure, so much of this retail is dead. But to your point, a lot of it's been removed, and what's left seems to be working very well. And just, what we've seen, generally speaking, on good corners, there's very little to no vacancy.
Yeah, the Amazon story, I'm fascinated by it. Sears should have been Amazon. They had the catalog.
Yeah.
If they had just taken the Sears catalog and digitized it and made it available, they had the distribution network. They had everything. It's just sometimes firms don't look forward enough when the current revenue is so strong, they didn't innovate enough, and that cost them. But it is interesting to thinking about Gen Zers going to malls and hanging out just like previous generations did. So
I don't know if they're spending any money there, though. But it's still too early.
Building memories, at least.
I did hear someone say you want to invest money on media content that goes to the smallest screen, not the biggest screen. And so maybe movie theaters still have an uphill battle ahead of them. But
I will tell you this, though. It is interesting thinking about retailers. They're going to experiment as much as they can to meet their consumers in whatever format they want. And mixed retail and online shopping, that is a thing.
Oh, yeah?
It used to be you'd go to a store if they didn't have your size, it didn't have what you wanted, you'd have to go looking other places. But now, we can have that ordered and delivered to you. And sometimes it's the opposite. I want something, I order it, this store has it. I'm going to go to this one store. It reduces the search time. And so building that brand loyalty becomes a little bit more important. It's not just sort of checking one versus the other. You got to make them wanting to come back and come to your place and visit your website. But that mixed use of in-store and online and combining it, they're going to continue to experiment with those things because they're just always going to be trying the best they can to meet their consumers. And so Amazon trying to open up some stores, that makes sense. I've always thought it'd be interesting to do. Do you remember the old Boston store? Some people, when I grew up in the Midwest, it was called service merchandise out there.
Okay.
But they had a fixed number of goods in the store. You go in, you fill out a little card, and you give it to them, and it's delivered. I've always thought that some things that are so commonly ordered on Amazon every day, maybe they'll experiment with something like that again. That there's a certain number of things that are always being asked for, so you just click on your phone, you order it, and you go and you pick it up. So they're going to continuing experimentation with all kinds of different formats, but a mixed format is something that we're going to see more and more of as they try and reach those consumers where they are.
Yeah. So in industrial, I feel like the numbers probably aren't as much a reflection of softening demand as much as maybe too much construction of giant spaces in industrial. Can you talk more about what's been going on in the industrial sector and the reason for the rising vacancies and just sort of what you foresee in terms of good places, I guess, strong spots in industrial and potentially weak spots?
Yeah, construction was a big driver of that increase in vacancy. We had 2 years of record high construction for the industrial sector. Everybody and their brother wanted to invest in it when it was the only sector throwing off a positive return, and it was seeing tenant demand. The move to more online shopping during the pandemic, it caused a surge in tenant demand for space, and which led in the end to more construction as investors tried to build more supply to satisfy that need. Now, there's still, it's not as if the move to online shopping has killed industrial demand, or rather, a move to more in-store shopping following the pandemic has killed industrial demand. There's still demand there, but the supply that came in was just too much to absorb at once, and so vacancy did rise. There's still demand. It's going to be able to backfill, and the supply is now retreating. It's not coming at the same high level. It's not like overbuilding of Houston offices in the 1980s. Sorry to pick on Houston. But
we look at Houston office all the time, and we just have the toughest time. At least people can say that it's not as correlated to energy anymore, because for a long time, no one in real estate would touch Houston office because it was just too tightly correlated to energy prices. But God bless them, I think they diversified their economy.
They did. But the key issue, once you get an office building going under construction, the lead times are so long that if you're going, you go. And so even though the signals in the 1980s showed that, hey, we shouldn't be building anymore, people were just sort of forced with their loan covenants and everything else to keep moving forward on the hopes that maybe it would turn around. And that didn't work out well for everybody, and the market was oversupplied. Industrial is a different beast. You can develop an industrial facility in a much shorter timeline. You can have much more of a just-in-time delivery of what the building stock is needed. And so the pullback was much quicker, even though it was a record amount of capital looking to get into industrial. Once it was clear that the demand was slowing down, it never went negative. There's always been demand for that space, but vacancy's going up. And if the amount of construction that went in had come in empty, we'd see vacancy have surged even faster. The fact that you had 2 years record high construction and vacancy didn't go up more, I think just speaks to the strength of the demand that still was out there. But it's also concentrated in certain areas. If you look at the price impact on the industrial sector, when you translate through from what happened with income with the buildings and how did that translate through to how investors price it, there's kind of a divergence in pricing nationally. In the 6 major metros of the U.S., and that includes Boston, New York, D.C., Chicago, San Francisco, L.A., that's where the bulk of investment traditionally has been in the U.S., industrial prices fell about 2% last year for those 6 major markets. And really, that's a story about LA and Chicago. Those are the 2 biggest industrial markets there. I mean, some of the New Jersey stuff is in there as well.
Some of it maybe changes in logistics patterns with onshoring or global trade. I mean, I was shocked to find out some of the strongest markets were Oklahoma City, Nashville, Richmond, and Columbus for like the mega big boxes. Whereas, I think the sort of the gateway markets are experiencing maybe softening faster. I don't know if there's any evidence for
there's
that.
There's always changes. Change energy prices a little bit, and then those managers are going to the folks who the tenants and the logistics companies are going to tweak their networks incrementally with every change in the cost of energy and moving goods. That's just the nature of their business. But I think that the bigger issue for some of these is that when all that construction came in, it was a little more concentrated in some of these. LA is a great example. The Inland Empire is a great example. If you wanted to feed into that logistics boom at that time, what better market was a sort of thing. So some of these smaller markets didn't see as much construction, so you didn't have as much erosion in the income, and so prices have held up a little bit better in those locations. This is not to say that prices are going to collapse. I mean, a 2% decline in industrial prices can easily be erased within a year, given a slowing construction pace if everything else holds up with investor demand and tenant demand. But there is a bit of divergence there on that price side for each.
Okay. Well, you touched a little bit on Houston office. Would love to have you go a little bit more into office. I really enjoyed looking at your slides and seeing sort of the return to office metrics that you're tracking. And I was surprised to find out that there's virtually little to no vacancy in Class A office in many markets. So, maybe a tale of 2 kind of classes in office for sure. But tell me what you're seeing on recovery for office.
Yeah, and the office sector, it's kind of funny. A lot of people have been talking as if, there's a big structural break. Everything is different for offices now after the pandemic. In some ways, I just see it as a continuation of what has been happening since the 1950s. Firms look to minimize costs however they can. And that's been the story of the office market for some time. So you go back to the 1950s, half of all financial sector employment, maybe 40%, but somewhere between 40 and 50% of all financial sector employment in the United States was concentrated on the island of Manhattan. It's not that concentrated now. What started happening is that high-tech tools like fax machines, cheap long-distance phone calling, it allowed firms to start moving some activity to lower-cost locations like Jersey City, or take a small city in the Carolinas that was famous for pine furniture and barbecue, Charlotte. It's now a financial hub because they moved back office activity to these locations, the clerical stuff, administrative, and you could hire workers to do jobs there at a lower wage rate. And so firms are able to maximize their profits. I mean, it helped New York in the end because the folks who were left in the sector were the high-paying, big swinging wallets, as Michael Lewis might not say.
Yeah.
But the concentration effects for Manhattan were good because you had the big decision makers here, and it increased the average earnings here and increased the willingness to spend on space. But that eroded some of the job market here, but then it got backfilled in other ways. But it moved some activity away from the city. Over time, firms are probably going to be facing the same thing. If your job doesn't need to be in Manhattan, if you don't need the high cost of being around people every day, at some point, firms are going to look at that and think, I could probably do this cheaper if they were a remote worker, or if I hired someone in Monterey or Mumbai or the Philippines and move some more clerical stuff to an even lower cost location. So that's a challenge for the office market that's been a long-going one. I think that the key driver, you noted that the Class A stuff is improving. There's a bit of a K-shaped recovery. The way I look at it, there's a change in demand for commodity space and then the high-end space that's valuable for tenants where their business really depends on social capital. It's all about developing and spending social capital to make cities work. If your business is around visiting with people and talking with them about a particular investment or a particular loan structure that someone's looking at, some of that has to be in person. And it has to be, the quiet conversations away from the meeting room about, what are the desire lines your firm has versus mine. And that kind of interaction is really where business gets done. And so, the folks with the social capital, they're not just going to come into the city and just occupy some cheap commodity space just because it's cheaper. They're going to want something that's higher quality, befitting the kind of businesses they're trying to conduct. And so you've got that division going on. The commodity space, the older B and C stuff, it's going to be harder for people to fill that for a bit. And some of it's going to have to be traded out at lower prices. And to the extent that we're seeing distress in this cycle, the biggest component of distress is really in the office market. And in part, you had the biggest price changes there as everybody goes through and reassesses their need for it. But I think that need, it's not something new. It's a continuation of something that's been happening for a long time.
Yeah.
For a long time, firms have been trying to minimize their exposure to labor in high-cost markets for commodity stuff. It's the high value-add social capital jobs that can continue to drive the office market. And so that works well for a city like New York, where Manhattan, it's all about social connections. Some other cities, some of the office markets there, it doesn't work as well.
And so are you seeing a movement out of, just what we've seen is movement out of downtowns into suburban areas post-COVID for suburban office. I'm curious, where do you see office markets tightening?
Yeah, the move to suburbs, part of it was a long-term move. Nobody likes a long commute, right?
Yeah, but I feel like, 15 years ago, we kind of saw people move out of the suburbs back to downtown. So is this a temporary shift, or were we at the beginning of another sort of major transition on where employers like to be located?
Well, a couple different threads to pull on this. Yeah, 15 years ago, there was more of a move towards downtown, but it wasn't a huge move. There was a slight move, but it wasn't huge. What was happening there, it was a bit of a demographic change. The millennials were coming into the labor force. Mm-hmm. And they were in the city. And why were they in the city? Well, because they're in their 20s, and when you're in your 20s, you're going to the city because that's where the 20-year-olds are. It's about building your life. It's about meeting somebody who's going to be your life partner. It's about going out with friends and going to clubs. So they were in that part of their life cycle, and living and working in the city was a great place to be at the time. The millennials, they're older now. The Gen Z is taking over that role, but they're a smaller demographic group than the millennials. The millennials created a surge in demand for housing in urban areas, but like every other generation, there comes a point when you settle down, you have kids, and suddenly that house on Long Island or out in Parsippany looks a lot better than living above a tattoo parlor in Bushwick. And that kind of change also changes their demand for where they want to live and work. It's honestly the thing I struggle with. I think some of the folks in sort of that generation, as they're starting to have kids and settle down, they're the ones I think at times are most valuable to have in the office to educate the Gen Zs and bring them along. But as they move to the suburbs, then they're more likely to want to work from home because they've got all these other responsibilities that they're trying to juggle, and that commute time is wasted time to them. So it's a real tricky balancing act for firms to think about how they get those folks in there. But in terms of the markets where you're facing those challenges, it tends to be a little bit more the dense urban markets because you have longer commutes in these locations, and so that's a higher cost for those workers. But the more suburban-oriented cities, where most of the office market in the is in the suburbs, those tend to be the southern markets, and you didn't have as much of a work-from-home culture develop during the pandemic. Some of my clients in Texas were in the office the whole time, saying, it doesn't impact us. But although, to be fair, they pursued their own safety measures, kind of making their firms kind of a safe zone where everybody was tested and everybody knew what everyone else is doing. So it worked out for some of them.
So do you feel like post-COVID now we're at a steady state where we're looking at occupancies and vacancies and, short of taking more inventory offline, this is kind of what we can and should be underwriting?
One thing that I look at as a leading indicator of potential demand is what's happening for New York is the subway system. What's happening with subway rides? And I remember right after the pandemic in 2021, people were saying, just wait until after Labor Day. Just wait until after Labor Day. It'll be traditional, just like usual. Everyone will come back, and the offices will be full again. And they said the same thing in 2022, and they said the same thing in 2023. But what's been happening every year, the ridership gets closer and closer to a typical Wednesday from before the pandemic. Mm-hmm. But we're now at about 80% of where we were for a typical Wednesday, which, the subway's the lifeblood of the city. If you're in the city, you're moving around, you get into your office, you need the subway. And so that busy day on Wednesdays when people tend to be in more, you're still not at that full usage.
Yes. So I looked at that data, and I was a little bit surprised because the weekend traffic was higher than the weekday traffic. Yeah. And so I was thinking, well, that data probably takes daily riders versus rush hour riders. And I will say at the rush hour, and I'm coming from, I'm from Connecticut, it feels very, very packed. And I can't imagine it being like more packed. It surprised me when I saw it was only at 80%. And granted, that's subway versus train. But even being on the subway sometimes and talking to my employees this morning about it, they were kind of shocked that it felt like we had come back to where we were pre-COVID. But no, we're still 20% off unless it isn't taking into consideration the rush hours, the measurement during rush hour. And, I wonder if, maybe there are less people throughout the day moving, and is attested by, the weekend traffic being higher than the weekday traffic. I wonder if you could parse that more specifically on rush hour related traffic.
That's an interesting question. I haven't looked at that, but it's the other thing to consider is the MTA did pull back on the number of trains for a while. I'm not sure where they are now at the number of daily subway rides, daily subway train trips, but that could be another component of it. But either way you slice it, there is activity again, but it's not every city that's getting that. It's happening in New York. There's evidence Toronto is going through that, Chicago. not as much. There's arguments that some of it's politics, some of it's crime, some of the uncertainty with that. But I think it's also a function in some cities, what's the reason to be there? What's the social capital element for people to be there and be around each other? And if you don't have that, I think you're going to have a difficult office market in the future.
Yep. So let's move on to multifamily. There's a lot going on there. That was a darling, much like industrial, experiencing some softening. We do a lot of multifamily and really do believe in that asset long term. But tell me what you're seeing and how investors should be looking at this asset class.
Yeah, the apartment market was it still is the largest investment class in the United States, frankly, the world. The U.S. Apartment market over the last decade, it's been about 65% of the global apartment investment market. It was an asset class here long before any other country because many other countries had challenges in that. They were worried about the reputational risks of trying to evict grandma if you were an insurance company, for instance, investing in that. But even though folks are starting to address those issues and figure out the right legal structures globally, it still is the largest component. The U.S. is still the largest component of that global apartment market. But it's the growth in sales, it's been slowing. Investors repriced some of the assets that got majorly overvalued during the low interest rate environment in 21 and 22. A lot of syndicators came in, and there's stories that people can search on. I knew we were going to run into trouble when all the social media apps know that I like real estate, so I get all the search terms and everything thrown at me. On my Instagram, I was going through it the other year and just seeing these pitches from funds trying to raise money. Invest in our real estate fund. Better than gold, guaranteed double-digit IRRs. And I'm thinking to myself, do they have a compliance team?
Yeah, I see that all the time too. I'm like, wait, how come the SEC is hasn't cracked down on this? Shocked. But some people raising money over TikTok.
And guess what? Some of those folks, there's famous stories out there now of folks who blew up like that helped drive prices up dramatically for the apartment sector for a couple of years, and then it fell sharply. But price growth is back to a steady, stable pace, even though there's some challenges on slowing income growth. It's still kind of stable. But the way I look at it, it's almost as if you just take the RCA CPPI for apartments and you just plot it out on a chart. You can almost just draw a straight line from like 2019, skip over the pandemic and then the decline and the big jump that happened afterwards with the low interest rates. And then we're back about where we would have been if it had continued at the pace it had been before the pandemic. So, all those financial shocks of first lowering interest rates and then rising interest rates, it's as if the market has kind of shaken those off, and now deal volume is kind of at a stable but slower level. And it's still larger and more liquid than it was before the pandemic. It's not as if suddenly there's been a retraction in activity. It's just not growing as quickly. The opportunity set, people see the opportunity set, and it's being priced appropriately now. Yeah, and so it's just not growing at the tremendous pace it had been.
Yeah, no, I think I mentioned I was at CREFC, what was that now, a couple weeks ago, and one thing that a lot of the lenders had mentioned was how multifamily was a growing part of the stress book that they had. It wasn't the largest part, but just seeing more growth, and I think I'd have to go back to the exact numbers, but call it like roughly a quarter of the distressed assets that they have.
Although that's a different kind of distress because it's not, a lot of it is not fundamental distress.
Well, that's what it was. Is so much of the distress when they dug into it is really tied to sponsor related distress.
Well,
capitalization related distress, but the fundamentals haven't deteriorated on the asset as much as maybe interest rates, or what I think is really interesting as a value-add investor. To your earlier point, there was a lot of really bad operators that got in.
Yeah, and
it's great to be able to buy an asset because of bad management.
Right.
That's one thing you can change. You can't change cap rates or lease rates.
Yeah, it's not like the office sector where you have a lot of B and C properties that maybe the fundamental economic need has changed, and that's a real distress situation, as opposed to If it's just a financial structure from somebody who bought it at 3% cap rate in a highly leveraged loan in 2021, that's another type of distress. Although that person who bought it at 3% cap rate also probably mismanagement and didn't do the right capex that was needed. And so that becomes another kind of opportunity in distress where it's just coming in, swinging a hammer and changing things. But that's also a different kind of investment and a different kind of investor that's needed compared to the distress that we saw after the financial crisis. The financial crisis distress, it was just the capital stack was misbalanced. You had loans, LTVs that were too high, debt that was resetting to a more expensive level, and just everything had to readjust on prices. A lot of the distress today, it's more of that asset that was mismanaged or it doesn't have that same economic need. An office building. One of the things I've been following a lot on social media. There's a plethora of new opportunistic people who are documenting their purchase and conversion of buildings, and it's really fascinating. There's one in Kansas City, an old hotel I've been watching, and it's like a hotel from the 1920s. And it's just fascinating seeing them tear down walls and see, oh, hey, here's some horsehair lining. It's just, what do you get into with that?
Yeah,
but
it's
just
like
watch,
that old home, but for commercial real estate.
Exactly. But it's fascinating seeing these people, and it's not the large institutional groups that do that. It's people embedded in their local markets. They know the local supplier. They know, okay, if I got to get a contractor here to deal with this plumbing issue, I got to talk to Frank. I can't talk to Joe. Joe had that problem that one time. It's knowing all the ins and outs of that local city. So it's more the local developer, owner, operator dealing with distress this time, that physical distress. Now, the financial stress, there's some of that as well. And the folks who bought a 3 cap and maybe they managed the property okay, that's still a distress thing that's going to be coming through. And there's an opportunity with those.
So, Jim, I'm curious your thoughts. We've seen cap rates obviously go up. They haven't really come down materially. We've seen spreads come down materially, far, sort of acting, very differently than obviously cap rates. So financing's coming in, but cap rates aren't exactly. Where do you kind of see, you think there's more expansion left in multifamily cap rates, or do you think that we're at sort of a baseline that feels comfortable going forward, or maybe even the hope of some compression?
Let me talk about how people should think about cap rates and what drives them.
Yeah.
A lot of people look at, what's going to happen to 10-year Treasury? If it goes down, cap rates will go down. Well, it'll be good. And that's not the only thing that drives it. It influences it. They rhyme, but there's other factors in there. If let's say 10-year Treasury is flat, if income expectations change, if everybody sees that, hey, rent growth is going to accelerate, investors are going to get excited about that, they'll bid up the value of those properties, and they'll tend to push cap rates down.
Yeah, value add. Yeah.
So that's one thing that drives cap rates, the expectations and income. Another thing that drives it is investor perceptions of risk. If the spread between, say, the Moody's Baa Corporate Bond Index and 10-year Treasury is widening, that shows that investors are getting worried and wanting to be paid more for the risk they're taking on of lending to corporations who might default, as opposed to government that technically won't. So you've got more risk building up. They're going to tend to push cap rates up. And then just general liquidity matters as well. If there's only one buyer coming to buy apartment buildings in Birmingham, Alabama, well, that makes it fairly illiquid. If you got 20 different investors coming in at once, you've got a better situation there. So that liquidity, both at the national level for the sector, but then also market liquidity, matters as well. And so it's a tricky interrelated thing, because some of the liquidity issues also relate to the income growth for a market, some of the increases in the risk perception that investors have. It also gets tied to inflation and the 10-year Treasury. But the key point I want people to think about is that don't assume that cap rates necessarily go down if interest rates go down. In fact, if interest rates go down, a lot of times that's a sign of an unhealthy economy. When the 10-year Treasury was at 60 basis points, maybe it was great for folks investing if you can get cheap capital, but that was only coming about because there's so little demand for money in the economy, because there's so little demand for investment, and the growth that you need for income just wasn't going to happen at that time. Heaven help us if we have another case of the 10-year Treasury at 60 basis points, because in that size, that your NOI is going to be challenged, and that's something that you're going to see challenges to cap rates from that. So, where cap rates going to go? It really depends on all these inputs. But the things I'd look for are what's happening with overall liquidity, what's happening with investor perception of risk, what is happening with inflation in the 10-year Treasury, and the combination of these effects are really what's going to drive cap rates.
I mean, I want to agree with you, but I feel like real estate investors in particular don't really listen to the noise. I feel like they really look at the asset and the fundamentals. And when you look at real estate values and cap rates, there is a big correlation to interest rates. And so, there's a story of capital flows, and capital flows are driven a lot by, in a relative universe, what you can earn in the bond market or the U.S. Treasury. So there should be some sort of connection to that. But generally speaking, I think, the larger thing is I saw, you had some great information on a lot of these institutions. They may have, set 10% allocated to real estate. And they're probably not changing that based on the noise going back and forth. They're probably saying, well, we'll keep our real estate allocation at 10%. But the problem is the capital flow, where you have these funds or assets where the capital's locked up in because they can't get out. Funds are taking longer, and you've got a lot of great slides and information on that. And so that capital is not able to get back into new transactions because there's no transaction activity. And there's no transaction activity, I think, because of interest rates. So this is me being a little bit more pessimistic, but I tend to believe that for better or for worse, there is a very strong correlation. Although I do agree it's not everything. Like there's other parts coming into it. But the bigger one is just capital flow. And I don't think capital flows are reading headlines.
Well, here's the thing. You're right. It does impact it. I mean, it is one of the things that impacts it. The way I describe it, like if you plot out 10-year Treasury and a cap rate, you'll see the gap widens and narrows at times.
Sure, it changes.
There's
that spread.
There's an analogy on this that I picked up when I was in grad school. It's called "The Drunk with Their Dog." It comes from I forget which economist wrote this, but it was some British economist talking about someone leaving the pub with their dog, because that's what they did. You take your dog to the pub and you walk home. You're walking home. You're not on a leash. The dog is following you on kind of a similar path, but they're going across the street. They're sniffing something.
Totally,
they're coming back to you, but they're generally following the same path, just with a bit of a drift on one of their parts. And that's kind of what cap rates and interest rates are. And that drift is caused by all these other things, like capital flows. Again, if you're looking at Birmingham, Alabama, and you've got 20 bidders on a deal on a regular basis, and suddenly there's 40 bidders on a deal because everybody suddenly loves Birmingham, suddenly the capital flow is going to help push cap rates down just from that process of competition. So understanding which markets, one thing I always like to look at the emerging trends report from the ULI. It's a little bit backward looking because when they pick, here's the top markets for the year. It's a little bit backward looking because by the time it ends up in the report, people have already been invested in those markets. But it's still a useful indicator of where the capital is looking. But it is tricky, and there are a network of things that can impact pricing. So it pays to take a deep look at every deal and think about what other forces might be influencing this.
So you've done a lot of great research on capital flows. What are you seeing capital flow wise in real estate? Feel free to talk about debt versus equity. We talked a little bit about that, but then largely also a lot of interesting facts and slides on where it's moving throughout different product types. And
the capital raising, everyone I'm talking to still says that it's still been difficult. And you had a great point that I think I should dive into a little bit. A lot of funds had raised money, they've got investments, and they haven't closed out every investment yet. And you have a lot of funds where they're probably a little bit beyond what their original life cycle was, as they're waiting for a slightly better moment to sell. And that creates some tension between LPs and GPs, where some folks, they want their money back now because they see other investments that they could put that capital into they may do better.
Sure.
Versus a GP hoping that if we can get everything working right, then we can protect more capital for everybody. So there's a tension between the LP and GP community on that. But what it does, it makes fundraising and getting that next fund off the ground a little bit difficult because there's a little less money coming in. A lot of the research people that I deal with, they're research people at these investment funds, but really they're helping with the process of, they're telling the story to other investment advisor type folks. They're telling a story about why they should be in real estate and why they should be in their fund in particular. And talking with these folks, it's been a slog for them since 2023. It's been harder and harder to raise money for equity. I mean, there's some cracks in that. There's some folks that are starting to do a little bit better, and some folks really did well with new vehicles. The non-traded REIT world was fantastic. The NAV REIT world, rather, was fantastic for a bit. But the equity, fundamentally, it's still underperforming debt. And this is the tricky thing. If I look at the MSCI AFOE, our fund index for commercial real estate in the U.S., it's still underperforming our debt indexes. We have a debt index for subordinated and mezz debt, and another one for senior loans. And the way to think about debt versus equity in the capital stack, you have the high risk, high return equity. If something goes wrong with the investment, it's high risk in a sense, not in a mean variance, volatility, index kind of context risk. I mean, situational risk. Am I going to get paid back? And if I go under, I lose everything on the equity side. Versus on the debt side, if there's a problem, well, I can foreclose, I can capture some of that in the sale. But the returns are still outperforming for the subordinated mezz index and the senior loan index. It's outperforming our fund index for equity. So you get that kind of situation. If I'm a pension fund and my pension advisor is telling me that, oh, look at the MSCI index, debt is still outperforming, they're going to tell them to still put more money into debt because it's just on a lagging basis, it's still overperforming the high risk element of it. So it's going to be difficult for all my friends in that real estate research capital raising world to raise money for equity going forward, given that underperformance relative to debt. I mean, at some point it'll change. At some point things reprice enough for offices, or there's enough growth and the returns pop up, and it should at some point be higher than the debt returns because you're taking on less situational risk in the debt stack portion of the stack. So at some point it should reverse, and at that point it'll be easier to raise capital. But for now, it still creates this situation where debt still looks attractive to investors.
Yeah, and it's something that benefits us, but it also is something that cuts both ways because you can't have a great real estate market without healthy real estate equity, funding transactions and doing deals. And so we have seen a lot of, I think we talked about, there are real estate private credit tourists that were the equity guys, and they're now touring through. Some of them, maybe this will be a permanent part of their platform, but others are kind of doing debt because they can't do equity or they can't raise money for equity. And I'll say too, on the corporate credit side, we've seen a lot of shops that have built out very successful corporate credit businesses that are now moving to real estate equity because they like the spreads in that space and they're expanding. And in fundraising world, I would say over the past 10 years, it was dramatic change because most institutional asset managers did not have a private credit allocation, let alone a real estate private credit allocation. Mm-hmm. So all of that changing. There's money in the space in private credit. It's created a very healthy refinancing market at a time where there needs to be a lot of options for these borrowers that are coming up with a loan maturity, and their LTVs aren't what they were, and so they need maybe some more flexibility that a private credit firm can give them. But it also is an interesting time too because CMBS is coming back very strong, like going on maybe its third year of being very strong. Bank lending's coming back. Insurance companies are certain lending. So it's I would say a great time to be a borrower if you can raise the equity.
Yeah, right.
And that's a problem. So I don't know, when does it change or what's your view on this?
Well, listen, you're right, debt tourists, there are some. And I think it's important to look at the firms that are actually investing in having the right systems to account for loans, setting up teams that can underwrite loans properly. And because it makes sense for some of these firms to, hey, this is a way to raise money and deploy money when the equity side is down. It'll be better for our business to have a diversified business where we can address whatever capital needs people have at the moment. So some firms get that, and they're making those investments. I think that'll be good for their long-term growth. Some other firms, it's just, hey, we're going to do this for a little bit. We're not making a big investment in it. We're going to make a couple loans. We'll just keep the lights on for now, and they'll move later. It creates a situation of competition for lenders, though. And yeah, you need some equity. You need some clients for everybody to chase. And that's going to be challenged for a bit with the way you have people still locked up in funds, not able to redeploy that capital into more productive investments moving forward. If you look at the J curve or the performance of some of the funds from the vintages that have come after the pandemic, they're really not up where they should be yet because of some of the challenges of repricing and some of the challenges on the tenant side. So it creates some problems where that capital doesn't move in right away. There had been a lot of hope that, after the financial crisis, all this cross-border money came in and bought everything on the cheap, but we are falling down to even lower levels of cross-border activity last year, and there's signs that the fundraising for funds looking to deploy capital in the U.S. Was not so great in the second half of 2025, where some of the growth and uncertainty was making folks look elsewhere. We won't see the numbers on that until we see the actual deployment, the actual purchases, and maybe that'll be a late 2026 thing before we can actually see the impact of that. So we're trying to dig into the funds and track more of that for some products we're trying to build around just the tracking of what the funds are doing. But it's, so you have that bit of a delay issue going on in terms of, how that capital flows. But, when does it change? I think you just need some more repricing of assets that allows the equity returns to come back up again to a point where, it has that traditional balance where you're going to get more return for taking on more risk than you do on the debt side. And that'll come, but it'll be repricing from either steady improvements in income or just more assets selling on the cheap. And we're seeing less of that now. We're seeing a little bit of price growth for just about every sector. Not tremendous price growth. You're not getting the double-digit growth, but there's a bit of a stabilization compared to where we were in 24 and 23. And so, if that continues and starts to accelerate, that'll help bring returns up.
Yeah, I feel like data centers have been soaking up a lot of that real estate equity. And then also these secondary funds that are trying to raise money and purchase assets out of funds in the secondary market. I do believe that as prices are stabilizing, and we have seen stabilization, the argument for those secondary funds will be not as strong as they were, because hopefully the portfolios start becoming healther, and a better way to access those deals is just through the direct markets. But you do need a repricing, and I'm curious, what's your view? How does that happen, and how long is this going to take? And when you're suggesting repricing, it's clearly like a volume thing, but do you think it's also a cap rate thing where, cap rates need to go even higher where they are today?
Well, let's, you give me three things here to digest.
Yeah.
So let me get to, I find this one fascinating for us as secondaries. Every time there's some sort of downturn in the market, there's new financial innovations that come out of it that come about permanently, that have some permanent sticking. Look at for instance, after the S&L crisis, CMBS had been around. It was a sleepy little vehicle. Nobody really traded it. There was very little of it, and suddenly there was a credit crunch, and it allowed folks to step up and introduce a lot of capital and a brand new vehicle to many folks that had staying power. And the CMBS market has been a significant market since then, because it reduced the cost of capital for some borrowers, provided capital at a critical time when people were liquid, but it has staying power because it fills a role in the cost of debt versus the structures around the debt that just wasn't met. And so financial innovation and shock leads to something new. Financial innovation in a new shock around these secondaries. Now, secondaries, that was something that happened a lot during the aftermath of the financial crisis, but people are better organized around it today, more GP-led stuff, trying to find other ways to introduce liquidity into an otherwise illiquid asset class. And that innovation, it probably has legs where folks look at that and think, okay, if I need the liquidity now, I've got these other vehicles, and it changes how I think about these sectors moving forward. So I wouldn't be surprised if it sticks around. It doesn't have to just go away because suddenly everything's repriced and you can buy assets nicely. Folks may want for other reasons. Just I'm changing how I think about my portfolio. I need to reallocate out of this real estate fund and into more tech or biomed or whatever they want. But it provides something that wasn't really around before and provides a little bit more liquidity. So I wouldn't be surprised if it sticks around in some form, even after everything's happy and prices are back and everybody's back above water. So that is something that that's been a truism. Financial distress leads to new innovations.
I totally agree with that, and I think you make a great point on the secondaries. They provide liquidity without a transaction. Yeah. So you have these stabilizing these innovations within the capital markets that are stabilizing the markets, and there's a lot of people really hoping for forced liquidations. And because of the secondaries, the investors in those assets can get out without actually having hit the market. And same thing, obviously, in private credit, where private credit can step in and be able to take out a bank that would otherwise maybe have an uncomfortable LTV without forcing a liquidation. And then, there's clearly, a loosening in maybe the need to liquidate assets amongst general commercial real estate lenders, which are also keeping up the markets. But there is a little bit of frustration for the reset because some of these innovations are allowing, these deals to go along for longer.
Yeah, and so it limits some of the price discovery.
Totally.
Because that secondaries market is still an opaque market.
Oh yeah.
We've been trying to add that to our data set and get information on secondary trades. It's not very easy to crack.
Sure.
But there's probably signals in that listen, if someone is buying shares of a fund for 75 cents on the dollar, then that probably has implications for if you went to market and tried to sell all the buildings inside that fund one by one. Probably reflects something about what the discount might be. So that there's some information there. It's piecemeal. It hasn't come through very. People. It's an opaque market. People are doing things and they know what they're doing, but they're not necessarily disclosing it to everybody else yet. And that markets as they get going, it's a lot. That's often what happens. You don't have a perfect information at first. We're trying to help expand that, get more information. I love that because I always want more data. And it's like, oh great, we got this new data set. Maybe we can use that to think about how it impacts direct property pricing. But getting a discount from selling out of the fund, in some ways that can make the fund live longer without forcing that liquidation, because if I can recapitalize that way as opposed to selling off some assets to try and get the money to pay back people who want out, well, when I do that, suddenly I'm revaluing everything down, and it could be a ruinous exit.
Oh, yeah.
And so that might help forestall some of the big distress stuff that people were hoping that they could see in this downturn.
Yep. The you just look at when the market was really hot, 2020 to 2021, 2022, and a lot of those deals were short-term financing, so they were priced 3 + 1 + 1. We're kind of there in the market, and then a lot of the funds too. They're, I think, hitting extensions, and there is within these funds set lives, and they can go into continuation vehicles, which are kind of like the secondaries. But there is a strong desire, I think, from everyone, except for maybe the people that are still trying to hold on to these assets, to see this reprice. And I'm curious, going into 2027, 28, 29, do you anticipate for me, it looks like there'll just be sort of a continued, slow repricing that might take 5 years, or maybe we're going to see a lot of repricing happening this year. And I don't know if you have a perspective on that, or if these funds and lenders can continue to extend as long as they need or want?
It's going to vary by type of capital. For the lenders, listen, the CMBS, when it matures, it's going to mature, and then some hard decisions, some of the assets are going to have to be made. And that's particularly interesting because some of the big office towers, CBD office towers, the lenders that were most dominant there were either debt funds or CMBS. So there could be some challenges, but they were typically 10-year terms. So it's not as though it's going to happen overnight. Now the debt funds, they tend to do shorter term loans. So any CBD office tower that maybe isn't one of the favored ones. I mean, if One Vanderbilt, if the loan was up today, people are going to be lining up around the block to try and finance that, as opposed to more commodity space in a non-famous location. Maybe they'll have a harder time on that. But the debt funds did a lot of financing of that as well. And there, they were more flexible in terms. They could do short-term loans, and so maybe more problems show up for some of those assets. But every lender has different requirements, and maybe some of the banks, their regulatory environment was not being looked at in a way where, let's force everything to be repriced. There's less of that kind of pressure on them today to reflect everything so that you don't upset the boat and create more of a hassle in the economy. So watching the motivations of every type of lender kind of tells you a little bit about what they might face and what kind of loan that previous owner had.
Okay, I'm going to switch gears a little bit. Go back to uncertainty, and this is probably where things get a little bit spicy or fun. There's clearly a lot of uncertainty going on coming out of the administration, and there was the independence of the Fed, which we talked about, and how that might factor into capital flows. And then there's Davos and some of the other headlines that you're reading. What are you reading that gives you concern right now, or that you think real estate investors need to be paying attention to?
Yeah, there was a hope. I started making this point earlier, but there was a hope that maybe cross-border money would come in and buy things on the cheap, because that happened after the financial crisis. Part of that after the financial crisis is also a lot of Chinese money coming in. So it wasn't just about us, it was also about China opening up their capital markets for the first time, which they then shut down when a few folks got ahead of their skis. And they were buying stuff without the right kind of discipline that was needed. It was the government there determined that investment was too speculative. But
we talked about there was also a lot of Canadian money coming in after the Great Financial Crisis.
Oh yeah, and
then a lot of wealthy Russians were buying properties in gateway markets. So there was a lot of foreign capital coming in.
Yeah,
the Trump administration has made claims that there's trillions of dollars. I don't know what the exact number of foreign investments being made, which is not necessarily real estate, but go ahead and continue to pull on this thread.
The money.
Where is this? Is the capital there? It's not there. We're not going to see it.
It's not there at the moment. It's been pulling back, and largely because cross-border money. Traditionally, when you talk about cross-border money, traditionally, it's institutional money. It's just like it's public pension funds, it's sovereign wealth funds. That's what was different about the Chinese coming in, because it was behaving a little bit. The Chinese came in.
The Chinese, weren't they like EB-5 mainly? They were trying to go out.
Yeah,
they weren't as interested in the economics. Whereas I feel like Canadian investors, a lot of Canadian pensions invest in the United States. I still think they will continue, and I still believe they are, because it's one of the few really stable, attractive, large real estate markets in the world.
Well, yeah, this is the thing. The Canadian investors are coming in with a targeted IRR, like any other fund, like any other professional investment manager.
Yeah.
What's the risk of this investment relative to, as opposed to some of the Chinese money that had come in that people look to thinking, in the last downturn, cross-border money came in and bid everything up. That was more of a capital diversification play, is the way I describe it. You had the situation where if you had some wealth and you were in China, you could only keep it in China, and then they opened up the doors. And so it was natural forget about politics and everything. It was just natural, just from a diversification point of view.
Sure.
I want to put some capital over in the U.S. I want to put some capital in Singapore and other places, just diversify away from all the wealth I created building a modern city in Shenzhen. I mean, it really is amazing what they did there. And over the course of 30 years, go from rice paddies to a modern economy. So if you go through that, at some point, you take a little bit off the table and you diversify it. It's nothing bad about China. It's just like what you do. You diversify your portfolio. But some folks got ahead of their skis, and some of the money was coming in, was doing things that weren't really like an institutional investor, thinking about targeting a certain IRR. Now, the Canadians, that's what they do. It's all very professional investors. There's some individual investors buying small properties, but the stuff priced $10 million and up, that was the institutional world, and they're doing the same stuff where they're looking at, how does the investment compare against the index, and how am I going to get judged on that by my manager? And that's the behavior that a lot of cross-border money goes through. And so it was already pulling back, because the same way that the investors in property here, just the domestic investors, if you look at the returns, they weren't as good as debt. And so it was harder to put money into the equity. So they were pulling back just because of that.
Yeah.
Just because of that, they would have pulled back. But there's not a lot of evidence of it yet. But in fact, there's a lot of talk about uncertainty about the U.S. restricting capital flow moving forward. In December, there's one of my favorite talks I give every year is in December in Toronto. And when you go to Toronto in December, you're serious because it's cold. It's not like going I have to go to Miami to go to Craft
I don't know why they have the big real estate conference in Toronto in December, but maybe that's the warmest place in Canada in December.
You're probably right. So. But when I was there, the one chart I pulled up said, hey, listen, there's a lot of talk about what happened in the United States this year and the new president.
Yeah.
But in 2025, it didn't change where Canadian investors were deploying capital worldwide. They're some of the biggest global investors because it's a relatively small country, but wealthy, with few real estate assets to invest in. Yeah, they have real estate assets, but it's a lot of big public pension funds trading assets back and forth.
Well, it's also the wealth of theirs highly consolidated. They don't have a lot of pensions, just a few, and they have a lot of dollars to put out. So you need some. You
need some other places.
Yeah, you need a big market.
And the United States was always traditionally the biggest place that they would go because, well, number one, half of the U.S. investment market is within a 2-hour flight of Pearson. We speak the same language more or less and play the same sports. The same TV. It's so many cultural connections. So it was easy for them to do. But in 2025, if you look at the share of Canadian outbound capital going to the U.S. versus the share to Europe, at the beginning of the year with the surge of uncertainty, people are saying, Canadians are going to step away from the U.S. And there are signs of the Canadians stepping away from the U.S. It's clear that Canadians are not happy with what's been happening with the government here. We have our index release event every year in February in Toronto, and I'm going to be up there in Toronto giving a talk about what happened with Canadian returns. Last year, I was up there doing the same thing. I was on a crutch at the time because I had a meniscus repair surgery, but I still got up there to do that. And I was at a bar, and a guy heard my accent, started yelling at me that you're an American, I'm gonna beat the crap out of you. It was. I've never had anything. It was a nice place in downtown Toronto, but and his friends pulled him away. I'd never had an experience like that before in Canada. I mean, it's always feels just safe. But clearly there was some anger there, and you can see it in other stats throughout the year. You look at the numbers from StatCan of like Canadians going to the United States. It's down tremendously. Just another anecdote on that. I had a trip to Vancouver last year, and I bought my ticket. I was just at the 2-week mark for our corporate travel requirements, but it was still cheaper than the round-trip ticket I bought to go to Dallas when I bought it 3 weeks ahead of time. And Vancouver's a lot further away than Dallas. It's just there was less demand, and the plane was half empty. There's just not as much of that travel. The point of this is that there were all these indicators suggesting, hey, there's less Canadian interest, but the dollar volume still continued. But at the forum, I was talking with a couple folks involved in the capital raising world, and they're saying, Jim, that's a backward-looking indicator. Everyone I've been talking with, these Canadian funds, they don't want to commit capital to the U.S. funds for the year ahead. And so the deployments that they made in 2025 is based on capital they raised in 23 and 24. And so if the Canadian capital does pull back because of all the chaos, it's going to happen in 26 and 27. And so we'll have to be watching that closely. But it's not as if there's some new group like the Chinese that were coming into the market for the first time. They can buy stuff for the first time. There's no big change in the global investment market going that way. And we just have to watch the deployments. There's an argument out there that there's less money that has been deployed from the Canadians, and that could dash some people's hopes that maybe cross-border money comes in and rescues some of the repricing.
Well, we have seen cross-border money coming in from South America, and there's a different story there. And obviously, Florida's felt that. It feels like Miami now is sort of, maybe the financial center of Central and South America.
It has been for some time. It has been for some time.
But I'm curious on any thoughts on that. I mean, we've seen a lot of growth with South American investors, and it appears to me they understand real estate. And these aren't necessarily institutions; they're high net worth individuals. I think trying to get out of high inflation economies and protect their wealth.
Yeah, talking with clients who raise money in that high net worth space, the areas where they were most successful in recent years is any country that went through a change in government where it's more of a leftist government that came in, and it became a case of people just thinking about how do I diversify some of my holdings here,
sure,
and maybe protect a little bit of capital by moving some of it into a fund into the U.S. And so it's capital raising, but it's not like going to public pension funds. Again, it's the high net worth folks. And so it's different vehicles. And so, yeah, there's money coming in on that, but it's harder to see because it's not like a commitment made by, CalPERS makes a commitment. There's all kinds of public disclosures. It's some family money. They make a commitment. The managers know about it, but there's very little disclosure. And so, but people I talk to, it's all the markets where you've had a change in governments that people are trying to protect some of their capital from potential changes in tax law and just ownership interests.
Yeah, I also feel like the Middle East has been pretty steady. So in terms of capital raising, both Israel and then MENA region, but so we have seen a lot of capital from there coming into the U.S., but clearly Europe is not happy. China, this is probably something going on for a long time. In Russia, there's reasons for that. Canada, though, it is like, I think a pretty tough loss. They were such a big part of our real estate economy. So hopefully what you're saying doesn't come to pass, but we'll see. I do feel like, this administration definitely wants foreign capital, just not probably foreign migration as much. But, we'll see how that plays out.
It's tricky at the same time because if one of the reasons that the Canadians could also invest here, they were selling goods into the United States, and then they earn U.S. dollars. And what do you do when you have some U.S. dollars? Well, you invest it in some U.S. dollar-denominated assets like an office building in Manhattan. And so it was a virtuous cycle. If suddenly we can't, if foreign countries can't very easily sell goods in the United States and earn dollars, then they're not going to need to recycle it into U.S. dollar-denominated assets. So it's kind of interrelated. But the Canadian investors, at some point, it's not as if they're going to, I don't think they'll just fully write off the United States and never be back, but they'll probably reduce the allocations a bit if what everybody is saying is true, that the capital raising just isn't working as well now. But there's a need to still buy some assets here in the simple sense that we do a study of the size of the global investment market every year. My buddy Hari pulls that together with his team, and they show that year in, year out, the U.S., about 45%, 46% of the investable assets for the institutional world are here in the U.S., globally. And that's punching above our weight relative to the size of the market. So if we've got that much of the investable market, it's hard for all the other regions of the world to absorb all the capital that goes into cross-border investing globally. It's not to say it's all going to stay here, but some of it probably will. But for a while, there's going to be some uncertainty, and it's going to be harder for folks to make decisions about buying stuff here. And if what the capital raising folks are telling me is true, then it's going to be delayed for a little bit.
Yep. Well, hopefully the United States still remains the number one destination for capital. I think it will. I'm pretty patriotic, and I just can't see that capital going into any other market and getting just sort of the business-friendly treatment that you get in the United States. Now, there might be some political stuff between nations, but generally speaking, pretty darn business-friendly. So you mentioned the dollar. I think that's a good segue. The deficit is a concern, although maybe it's improving slightly. The long-term strength of the dollar, and we talked about maybe Fed independence might tie into this, but what are your thoughts on the U.S. dollar, and I guess how does America deal with where we are today, sort of, moving towards a monetary cliff and a fiscal cliff, both of them? What are your thoughts?
That's one I'm not really prepared to talk about. Maybe edit
really
that part out.
As an economist, it's like,
well, it's
it's the health of the dollar.
Yeah, it gets a little bit further than the real estate data. So that, like, if you had a scenario that you wanted to paint of, like if you came to me and said, hey, there's a weakening dollar, what's this going to do to real estate? I could talk about that easily.
So let's start there.
Okay.
There's a weakening dollar, and I'm not even for sure, because it seems like all the currencies are weakening globally, but how does a weakening dollar help U.S. real estate? And then as our dollar weakens, do you have any insight into how that is on a relative basis with other weakening currencies, like maybe the pound or the euro?
Yeah. There's a perception that people have that, if the U.S. dollar is weak, then all these cross-border investors are going to come in because suddenly we're on sale. Doesn't always work like that. A weak dollar is a sign of a weak economy. If the dollar's strong, it's strong because we're producing, there's a lot of investment, people want to be in this economy. A weak dollar, though, creates challenges for the NOI of properties. Because if we have a weak dollar and a weak economy, suddenly that tenant that you're hoping you could push some rent increases on, you really can't, because they don't have as much need for the space, and there's not as many competitors looking to step up. So, if you're rooting for a weak dollar out there, thinking that cross-border money will come in, may not happen like that. So, a strong dollar is generally reflective of a strong economy. And the things that really matter for those cross-border flows are really, it's not whether the dollar's strong or not, but it's the relative cost of capital across these countries. When I talk to German investors, typically what happens is that they don't hedge at the portfolio, at the asset level. It's like, and even in the real estate group, they won't necessarily hedge. It'll be sort of at the big corporate level across every asset class. And then we get a message down from the corporate CFO about, okay, you have to underwrite to a slightly different return metric now, given our hedging costs. And that translates through to, okay, if in the past I was willing to buy at a 6.5 cap rate, now I can only buy at a 7. And so that changes how they can actually invest in some of these areas. And so if you get differentials between short-term rates between two countries that make that hedging cost higher, suddenly less money's coming in. Even if the dollar's weak, it's not as if they're coming in here just because of a weak dollar. It's the finance cost differences that matter more. But be wary of thinking that a weak dollar drives people here because the income's lower, potentially. And that's going to be the more important driver of performance.
Fair point. Yeah, certainly there's a lot of countries with weak currency and it's not attracting foreign investment. So we're entering the lightning round phase of the show. So I'm going to ask you a question, and I would love a one word or a phrase. No need for explanation, although I might be curious if there is a need. But first one is, what is the most underappreciated risk in 2026?
Most underappreciated risk. I had to say it to think about it for a second. Underappreciated risk. The scale of the refinancings there is this wall of maturities. It's been pushed out a bit, but it's still out there. It still can have an impact at some point. It's just nobody's been forced to make decisions. If things get to a point where people are forced to make decisions, it can be painful.
Okay, good one. Moving on to the next one. What is the most underappreciated opportunity?
Most underappreciated opportunity, I kind of led with this early on, is retail and offices. Even though offices right now, if you look at cap rates for offices relative to long-term trend for offices, they're higher. Now, you're taking on some more risks. There's more challenges to income. The CapEx requirements are higher. But some of these assets have repriced. And in some cities, there's people back. It's just at a lower level. Private capital is already doing it. The buyers of offices for the year was really private buyers. Eventually, the institutional folks will see what they're doing, and they'll see that nobody lost their head doing it yet, and they'll follow. But the biggest repricing has been in offices, and that's one that I don't think the institutional money has really jumped in on yet.
No, they seem to be a laggard. But family offices are jumping in, which I'm very hopeful. I'm glad you said that. I would love to have more investors jump into office. What's one metric listeners should be watching or checking every month?
Here's the one thing I look at every month: the monthly job report. Just once a month it comes out. Real estate's just a box where the economy lives, and so we need to know just how many jobs are being created. So how many people are going into a job every day? They fill the space. They form the economy. And that's going to be the broadest leading indicator of where the market is. You can get into all kinds of details of maybe slicing out how much of the office job growth is created, how much industrial job growth and everything else. But just as a broad indicator, if you look at one number a month, look at the jobs report from the BLS.
Okay. I agree. I love what you said. Real estate is just the box the economy lives in. So last question. And this is really important for us, and I know probably every smart economist hates answering this because it's impossible to predict. But by this time next year, SOFR will be blank.
If I could reliably tell you where SOFR is going to be next year, I'd be on a yacht outside of Miami right now.
Oh yeah.
I'd be making so much money from that. I'd leave all this real estate stuff behind and just be living large in Florida and the Caribbean. So, where is it going to be? There's a lot of things that could drive it, but there's a bigger range of uncertainty today because the institutions underlied the stable, steady growth we had and the low inflation growth, they're being challenged and rearranged. How it settles out, final story isn't ready on that. And so some of the previous relationships you may have relied on to think about, this kind of job growth leads to this kind of inflation, this kind of demand for goods in the economy. It's harder to make sense of that right now because, all the rewiring that's happening underneath. So, again, if I could reliably predict it.
Well, no one can, but I mean, there's a lot of people kind of anticipating no cut this month, maybe 35 basis points or more. I think the Fed's meeting on the 27th of January. So I don't know if there's any sort of early signals. I think I'm not hearing or seeing anything.
I wouldn't be watching what the Fed's doing. They can cut the Fed funds rate. When they've been cutting it recently, interest rates haven't gone down a whole lot for like the 10-year Treasury. And part of that is they don't really influence the long end of the yield curve. They just have that control of that one little point on the short end. The long end is determined by the people who would buy the debt.
Oh, sure, yeah.
And there's reasons why you look at this and say to yourself, okay, the U.S. has this fiscal issue. Should I be buying that debt? Well, they've been paying off before. But you start undermining the institutions that supported it all, and it makes it a harder sell for folks to be buying that debt until we get some of the fiscal stuff in order and everything else in place, and until there's some picture on what all the institutions will look like after everything has changed. And so, the Fed can cut, doesn't necessarily do anything until investors buying the bonds on the long end of the yield curve agree that it's a more stable environment, that they should be buying more of it.
Well, that's why I think it's easier to guess SOFR versus U.S. Treasury. To your earlier point, there's a lot more involved in the U.S. Treasury pricing, but SOFR is really just the decision of the Fed. So, and Fed independence is maybe at risk right now. So, I looked at a polymarket graph, and I think there was a 70% chance that Trump gets his way by replacing Powell with someone that will cut rates. So. Interesting, but I can appreciate as a wise person that you won't get in the box of predicting interest rates.
I tell you, though, it is the case. There's been some studies of globally, just central bank independence. The degree of central bank independence is closely correlated with the degree of inflation in an economy. The less and this isn't. And this isn't supposed to be a criticism of the current administration. I mean, if a Democrat was in there trying to do the same thing to get control, to help get cheaper costs, you'd have that same kind of inflationary pressure. Governments like to spend. You need the central bankers to take the punch bowl away at times. It's just that's their job. But the countries where you don't have that independence, they tend to have higher inflation rates. Because the politicians, no one likes to say no if they're a politician. It's yes to everything. And so you need those central bankers to put some controls on things. And that's why the independence is so important. And so it's, if we lose that independence, then we lose the independence for future administrations as well. And so it's important to keep institutions like that in place that have, been really the source of the growth with low inflation that we've enjoyed in the past. So it's the evidence historically across countries is when you lose that independence, you end up with higher inflation, and so maybe this time it's different, but we'll see. Yeah.
So much to say. We could keep going, but thank you so much, Jim, for coming.
Well, thanks for having me here.
This is a really entertaining conversation. I thank you for allowing me to push back on you a little bit. Probably.
That's always fun.
Yeah, maybe should have pushed back more or less. I don't know.
I don't think we have enough time. That's a challenge.
Yeah. No, not for sure. We could do this all day. And that's it for this episode of Boots on the Ground. If you enjoyed it, please follow and read the show notes. Reminder, this podcast is for informational purposes only and isn't investment advice. RRA Capital and its affiliates may have interests related to topics discussed, and views are as of the recording date. See show notes for full disclosure. Thanks for listening, and see you next time.